if he decides to exercise that option to purchase your property for $1 million, you'll have made a $700,000 profit. Now, the person who owns the contract, who wants to purchase your property, knows that there is a huge development going on near your home, and they have they're putting in, I don't know, some super duper shopping center, and all of a sudden your property values are going up tremendously because this is a great place, and there's a resort going in there, and all of a sudden the properties in that area are going to double and triple in price, and you didn't know anything about that. So you took his $500, and now if he does not decide to come back and buy your property for $1 million within 90 days, then you get to keep that $500 and no harm, no foul. If he does come and purchase your property for $1 million, well, you've made a good deal of money on it, plus you kept the $500. The guy doesn't get that back, even if he does purchase your property. So that's really the analogy. I mean, the guy who's buying the option to purchase your property is hoping that values, or he'll be able to sell your property for even more than $1 million before that 90-day contract expires. And that's what he's betting on. But you know what? What happens to that contract over time? Let's say the start is today. He gives you the $500. You enter into the contract to sell your property to him for $1 million. Now he has the right to buy your property for $1 million, but he's not obligated to do that. So he doesn't have to buy your property for $1 million. Not like a purchase contract like you would when you buy your home, but this is just an option to hold the property and to buy it in a future date for $1 million. So he goes out and he tries to find someone else who is willing to take his contract and purchase your property for $1.2 million. So he's hoping to make a $200,000 profit on that property. If he finds someone who's willing to purchase your home for $1.2 million, he comes and he before the 90 days is up, he tells you, yes, hey, guess what? Hey, I'm going to buy your property for $1 million. And you are ecstatic. You are very, very happy about that. So he buys your property for $1 million. He already has a buyer for $1.2 million. He turns around and sells it to them for $1.2 million, making a $200,000 profit himself. And you have $1 million in your pocket where you can go out and buy another property. But what happens if he can't find a buyer? Well, if we started the contract today and 90 days later it expires, what happens to that contract over time? Well, if the 30 days pass by and he still hasn't found a buyer higher than the purchase price that he's asked you that you'd be willing to sell it for, then the value of that contract should actually go down a little bit. So instead of maybe originally it was worth $500, now maybe it's only worth $450 because 30% of the time has expired, has eroded that contract to the point where now instead of 90 days in which to find a buyer, he only has 60 days in which to find a buyer. So the probabilities of him actually finding a buyer at 90 days was much higher than it is at 60 days. And then let's say another 30 days has gone by and he has still not found a buyer for the property in which he can make a profit. Well, that contract now is worth even less money. Maybe it's only worth $250 because two-thirds of the time, 60 days have passed and he hasn't been able to find a buyer. So the contract that he has entered into with you is now worth less because there's a much lower probability that he is actually going to be able to find a buyer of $1 million or more. Actually, more than $1 million, because if he buys it for $1 million and he can only sell it for $1 million, he's not going to make any money, is he? So he needs to find someone who's willing to buy it for more than $1 million. And now 60 days have passed and he hasn't been able to find anybody. So that little contract that he has, the option to purchase your property, is going to be worth a lot less. Well, in the last 30 days, he still hasn't been able to find a buyer. And guess what? at 90 days after you originally entered into that contract with him, that contract date has expired, and he hasn't found anyone to purchase the property for more than $1 million. But since he paid you a premium $500 and the contract expired, you get to keep that $500, and now you are no longer obligated to sell him the property for $1 million. So that's essentially what happens when you go to buy a call option, an option who is hoping to profit from the price increase of a stock.